Good afternoon, everyone. Martin Redmayne here again for the INCandid conversation with Camper Nicholsons. I'm joined today by Thomas Veraguth from UBS in Geneva, a senior strategist. Very excited to have him on board. And obviously, Group Chief Financial Officer of Camper Nicholsons, Jenny Skoog. A relative novice to the industry, but someone who's got some really interesting experience in the world of investment and finance. And that's our topic, investment and finance in this marketplace. I'm very interested to talk about, once we come out of this crisis, once we get past the peak of, let's say, negativity, what is the market going to deliver to our client base? Our client base is anyone ultra high net worth individual who has something to focus on in the next 10 years, let's call it, in terms of a cycle of investment. So what is interesting this time with the Campers webinar is we have a brief presentation that is going to be driving the conversation that Thomas and UBS has put together. So without too much introduction from my side, I'm going to let Thomas start off with his slides and presentation, and I'll introduce topics and conversation with Jenny as we go through this session. So Thomas, welcome. Jenny, welcome. The floor is yours, Thomas.
Yes, thank you very much, Martin, for the introduction. So we go through this short presentation. I think I can move it on my own, if that's, yes, working very well. So we had at the 1st January of this year, the start of a new decade. And everybody was very excited about, okay, I have to make the focus and the prediction for the next 10 years. And that, of course, we have done like everybody. And so I don't want to go through all the different topics we find that may be relevant for the next decade, but you see a few of the ones that we selected, especially wealth concentration was a topic, but not only one, aging and maturing distribution. So we change a little bit the pattern, but it was also something that we have expected existing trend to accelerate. So it's not that the next decade will be from the 1st January something completely different, but we have a little bit acceleration in some different trades. And that, interestingly, from an investment point of view, we see that US equities have been the winners from this decade. They have, of course, after the financial crisis, also began just a very interesting reforms and very active policies, monetary policy and fiscal policies, and that have, of course, pushed the equity investment in the US. And also we had, of course, very strong thematic like technology, the best tech companies, of course, located at the American Stock Exchange, and this has been also a very strong performer, and this has influenced the last decade. So it will still stay a big topic, but I mean, we see otherwise a little bit a new decade coming into accelerating those trends. But yes, it's difficult to say in the next 10 years will be completely different. So I want to stay in this topic of accelerating versus completely changing the world, because after the many discussions we already had with so many colleagues and clients and brokers and analysts, and it seems that the consensus, and I would say that makes rather sense to me, is rather going to the direction of acceleration of the trends we already know about, we already knew. And one element would have been also globalization, deglobalization. But I think one consensus was also that we will go into lower returns. And this is not only because aging, but this is also a result of globalization, a result of high production capacity all around the world, the very efficient production chain, and so the margin of the companies are rather thin and skewed, and so the reason is then it's more difficult to earn money in this globalized world, and this is going to have of course, a negative impact on the return you can expect on different asset class. So what we do here internally, like other banks, we have our capital market assumptions. We do that for the main asset class, and you see the result for the past 10 years and the next 7 years, and you see whether we will have to go into more risks in order to achieve similar returns lost in the past decade. So I think this is a quite evident trend, and that will be rather also confirmed. But what we look at today through this crisis, the result of that is we began with this new decade, and we had our expectation ready to be implemented through the markets and the companies and the governments. And what happened, of course, was absolutely not expected. This was these fears about this virus and this pandemic, and also the response by the governments and by the different central banks that especially has produced a much higher debt level. So you see here a very nice chart made by our colleagues and from Barclays, and you see here back to 1870 what happened to the world real GDP growth rates, and then to the G20 advanced economic public debt in percent of GDP, and you see the result is very impressive. I mean, we are not in a war situation, even if President Macron words would tell us that he had interpreted that the kind of issue like a war, but we are still at a peacetime, I would rather say. And when you look at the history, the increase in the debt level that we can foresee, and the decrease in the production in the world real GDP is impressive, and is similar to what you can expect in a war situation. So it's something that was impossible to expect, and is going to change a little bit the decade to come. But again, it's not something that is a total game changer. It's something that is new, added to the trends we already observed. The trends are going to go further on their path, but we are going to add this question of debt and this question of recession that we will have to address in the coming quarters. Yes, so that will be a little bit the first section to have this situation clarified. I can't hear you.
What I'm trying to make sure, Thomas, is we look at this from the client perspective. How are they preparing for this? What is their current attitude or behavior as a result of what's happened?
Yeah. So if I look at what the clients have done, it's very interestingly that a lot of private clients have been very active in this environment. Something that we didn't discuss so far. It's very interesting to see that private clients have been very active, while institutional clients have rather be waiting in their portfolio allocation and not changing their allocation so quickly. So we have a lot of liquidity in the market, and a lot of private clients very active, buying at the market lows and making now a very nice return. Yeah. So yes, we had different reactions, but again, when we see that the kind of reaction we had from the different kind of investors, that was what you can expect in the market volatility. So nothing here, nothing really new, just that compared to 2008 and 9, there is a lot of cash on the side.
Yeah, yeah. Jenny, from your side of the yachting space, we've seen lots of events over the last few decades, and more recently GFC. What's this done to our industry, do you think? So James, turn your microphone
Microphone. Yes.
Right. So when I first got into the industry about 5-6 years ago, the first thing I looked at was what happened before the GFC and then what happened after. So as far as we can see from our stats, is that the market was pretty strong prior to the global financial crisis, but it was also not very regulated. It was much easier to get financing. We had a lot of clients. It was really like a boom in sales and so on. So pretty easy conditions. Then we had the GFC, and this obviously introduced, or after the GFC, it introduced a lot of new regulations, much more demand in terms of compliance, AML, and so on. There was also a decrease in the activity of our clients, a slight decrease in the order book for new builds and so on. And also we started seeing quite a large fragmentation in the industry with arrival of small players taking market share, basically. So during these years, we've seen also an increasing, I'll say, marketing fragmentation, quite a volatile and cyclic market, and pretty much every year, more and more regulations that affect us. Then in the recent years, what we've seen is there's been a arrival of new investors into the industry. We have also seen a move towards digitalization with the arrival of online platforms and so on. And also increased or new, I would say, interest into environmental and social engagement. So that's really what we've seen over the past years, leading up to the global financial crisis and after that. Oh, I can't hear you, Martin. Sorry.
Same sort of question. Jenny, where do you think the clients are at the moment mentally?
Today, I think that we're definitely now seeing some interest, for example, in the charters. I think people have been waiting to see when the borders will open and so on. Same goes to sales. We're really starting to see some activity. But of course, during the crisis, we had a lot of cancellations. We had a lot of sales that were put on hold due to travel restrictions and so on. But I think that our clients, like most people right now, are ready for European summer. They want to get out. They want to enjoy their lives. I think we've all gone through this period of a little bit of a reality check on what's important in life. And a lot of people now want to go out and enjoy their lives. So I do think that we're starting to see activity, and we're starting to see the end of I would say the big part of the crisis in terms of business for us.
Good. So Thomas, the lockdown has been a sort of fairly unprecedented event. What impact has that had?
Yeah, so I'm very interested to hear the comments on from Jenny. So I think we are still in overall in a high fears level, but we see clearly improvement. What I want to bring here is a chart that show you on the left the number of deaths per day, and on the right the average score of lockdown stringency. And what we see here, and I would say these are the facts that are going to stay here when we will try to understand what happened to us, sorry, and to what we have done to ourselves, is that we had a peak in the number of deaths that you see on the left, and something like a little bit after the peak, we began with the lockdown. And so at the moment where the number of days began already to decrease, we introduced the lockdowns. So we have some kind of experience made, is that the lockdown came on average too late, and so we we have an experience that will say, okay, lockdowns came too late, and so we have some kind of an experience that tell you lockdowns may have been ineffective in regards of having a mean to control the peak of the virus. And that's another way to show the relationship between the mobility restriction. This is the horizontal axis, and on the vertical axis you see the reduction in virus reproduction. So this famous reproduction rate, how fast this reproduction rate came down. And again, this is another way to show, and that's a UBS slide. So I'm very proud that we are strong enough to show this kind of reality, that France, Spain, and Italy were very strict in the lockdowns and the restriction in mobility, while other countries were less strict. And you don't see any relationship, any correlation from a mathematical point of view between the reduction in the reproduction rate and the lockdown measure. So the question for us is not the sanitary questions or lesser one, but much more how the world is going to understand all those things, and that confirm that my expectation is that we are going to forget quite quickly these events from an economic point of view, of course, and that we will see the people coming back in the normality, in their own normality. You know, you have always this question, what is the new normality? The normality is what the people want, what you want for yourself. This is the normality, and the addition of our normality for ourselves, that will be the normality we are going to go back. And I do not expect this new normality to be so much different than the other one. And one other element to, or one way to show that the normality stay rather the same over many years is the reaction of the risky assets versus safe assets during this volatility crisis. This is from an investment point of view, and we want to look at how the market reacted to this volatility. And you can, on the left side, you can do a basket. This is a JP Morgan chart from our colleague for JP Morgan. I take this because I think it's a very useful presentation. So when you invest in a basket of cyclical currencies versus a safe currency and gold, so safe currency would be Japanese yen, Swiss franc, and gold, versus the other cyclical currencies. And what happened is then typically that your investment in the cyclical currencies underperformed massively the safe basket, and this is something we are usually used to, so nothing new. The market reacted to this lockdown crisis, to this market volatility, in a way that you could have expected. Nothing has changed in regards of that. And you see also the flow into US bond ETFs on the right side. So what happened is we had some liquidity issues, and so everybody sold everything, including gold, from a volume point of view, not from a relative point of view, but from a US dollar point of view. So the investor needed liquidity, and they sold also US bonds ETF. The reason why we have this correction in the volume, and then it came back, and this is also a proof that we have enough liquidity in the system. So that means we had people having enough cash on the side to come back again in the market and bring the volume back to the level we have been before this crisis. So this is a way, a little bit a technical way, but I think it's a very interesting way to look through the market realities to understand what happened in the market. And we see also here the response that make me rather optimistic in regards of how the market is functioning and how the response are. Yes. So the last one is for this section in regard of what happened to ourselves with this virus discussion and fears is that we had this mobility. So this is an aggregate mobility return back to normality from transit, for driving, for walking. You see, this is a global figure also for JP Morgan. I like very much this presentation. And on the right side, you have our UBS typical mobility charts that show you which country is going so fast in recovering the level of the mobility we had in before this crisis happened. And the most important thing I want to tell about that is typically we look at those charts and we say, okay, it's improving. That's the only thing we typically will look at those charts. But those charts are telling you something much more important, is that there is divergence growing between the countries, some that are recovering faster than other, coming out of the crisis faster than other, and that's going to have a material impact on the next quarters and how we invest. So I wrote here below, so the ones that reopen quickly or never lock down, there will be the winners. Why? This is because we don't see any link between the virus and the lockdown. So the conclusion should be, now you have to end up these lockdowns and you are going to win. You should not fear a second wave. We have written about that already 2-3 weeks ago. We stated by the UBS, we are not expecting a second wave. And I think this is more and more confirmed by the reality. And also the countries that were late, they will lose market share. They will lose their responsiveness to this crisis. They will enter even more political crisis than the other one, and that's what the thing is going to matter. But we as investors, we can react to that. So we follow those realities and say, okay, we buy the winners and we avoid the losers. Yes.
Interesting topic, because obviously what we want to try and look at now is, where are the key regions or countries that people should be focused on? Is that purely down to their responsiveness to the crisis, or is there other factors involved?
Yes, there is an interesting chart that we have seen together where we saw Italy, France, and Spain being very strict with the lockdowns, and other countries typically that was less strict. What we see is that typically, and it's a pity, but it's now the reality, and those countries and the market is going to have to accept this reality, is that some countries within the Eurozone, especially, that were already weak from a fiscal point of view, have created the highest crisis risks on the top of the problems they already had. Yeah. And other countries that have performed better, you integrate or you include to that Germany, where you have seen the first quarter results for GDP were less of a problem than the results we have seen for the UK or even for France, for Italy. And so we still have growing divergence and pressure on the politics. So pressure on the politics is a good thing, because they are going to do the reforms. We hope the good one. Yeah, but yes, but I think this is the one element we have to take from all these crises. And again, Jenny said the people are coming back, and I think it makes sense, because we will soon realize the question we are going to talk about won't be the virus anymore, but the consequence of the policies that have been implemented by different countries. And this is something we can analyze very, very, very well. And so you buy the winners and avoid the losers again. So one evident consequence of that.
And that's pretty much how the investment world works anyway, isn't it? It's like, it's an observational analysis.
Yeah.
I think the question is like, where's the US in all this, in your opinion? Because that's one of our strongest markets.
Wow, this is a very strong question, because from an economic point of view, I think there is two things to consider. Is the one that, of course, they haven't this labor market regulation that avoid a massive increase in unemployment. So we have seen that they have a double-digit unemployment level above 40%. Others say 60%. So even it's an estimate for the moment. But they have created a lot of unemployment. The hope is that because of the dynamic of the US economy, that those people will find the jobs quite quickly again. We have seen some improving numbers, the last labor report on non-farm payroll, but okay, these numbers are a little bit suspect, so there is still discussion on how good those numbers are, but they have some kind of dynamic in the economy. The problem is now for the US is the political problem, that we see that of course the whole continent, the whole country is more divided than ever on a political base, and so we go now into this presidential election in November this year, and this is a very high question mark. So for the moment, we see still the typical dynamic of the US economy, but organized a big divide on the policy front that makes us a little bit reluctant now to say buy everything in the US. Wait until we will have more clarity in regards of presidential election, because this is, it's perhaps a pity, but this is certainly the topic that will be much more important in the coming months than the virus or even the lockdowns. So that will be the topic number one. And so for the moment, I will be a little bit reluctant to say buy everything in the US. It's too early. We need a confirmation. Yes.
Sure. Jenny, what's your current status on the business element of CNI at the moment, and this returning to normality? How do you see that emerging?
CNI, sorry.
No, I'm trying to Jenny, from Jenny's perspective. How Camper Nicholsons? How are you going to come back to normality?
Yes. So, what we have seen together so far is that we are entering a new decade with those trends. Trends are going rather to accelerate than to change. Then we have this very untypical recession that we are going to go out of it quite quickly, rather quicker than we would have estimated. Then we have this virus discussion and this lockdown discussion. I would say this discussion is already over. So the newspaper are still writing every day about it, but this story is already over. Now we are really in the stage of coming back, and this coming back is going to happen, and there is no reason to think for the moment that overall the luxury industry won't come back. It's a pity, but for Switzerland, it was less of a good news, especially for watch industry, because watch industry is a massive pressure. But other sector in the luxury brand should not suffer that much and should come back to normalities, because people have still cash on the side. The people that can afford luxury goods, the wealthy clients on your side, on our side from UBS, these clients seem to have been quite successful during the last months because they had a lot of cash before the market volatility, and many of them have some clients that have done that very successfully, much more than I would have done it. So that's a good news. And they invested really at the right moment at the lows, and they have made a very strong performance since then. So I would expect now the overall potential demand coming from our wealthy clients, both on your side, on our side, that will be rather stable, more stable than we would have expected from the overall that has taken a hit. Yeah. So your typical industry with time, but what Jenny said is something that's very important in my view, is industry and the quality that is required by the product, looking at what the clients are really expecting from us, that will be even more important. And also the fact that the industry, our industry, your industry, will be same situation to need specific solution, much more client-specific solution than ever, and that's a very good, I think, element for the one within the luxury industry that will be able to tackle these opportunities and to offer the good solution. Yeah.
Jenny, can I bring you now in to sort of talk about your perspective on this in terms of how Camper Nicholsons expect things to return to a normality?
And I'm very happy to hear that some of your clients, Thomas, has made some good money, and we definitely have yachts available in case they're interested. I think in terms of Camper Nicholson coming back to normality from this crisis, just to take a step back, I'd say that fortunately for us, we've been digitalizing the company for the last couple of years. So even though, well, this lockdown was quite an event, let's say, and quite a big thing to manage, I think, for every business, really, to move, to close down your offices and move your entire workforce to remote working within sometimes a day. But we were quite well prepared, so we managed to move everybody to home-based remote working and to continue to support our clients in the best possible way. Then I think now, as we are opening our offices again, although there's restrictions in terms of health requirements and so on, I hope this will, lighten up, I would say, in the coming months as well, so we can return to real normality. But having said that, I think that we have learned a lot from this crisis. So one of the things is that we realized that even more than maybe what we've done so far, we need to build a really lean operation. We need to reconsider how much fixed cost we have, whether we need to have all the offices that we have across the world, and to see how we can better use and optimize the remote working. Then what we will also continue to do is to heavily invest into digitalization, both for the benefit of our clients and for our workforce, basically. And then another thing that we learned from this crisis is that it's really important, and this is one of our advantages, is that we have several different revenue streams with very different business models. So some were heavily impacted by the crisis, such as charter, sales, and so on. But we also have yacht management and other business lines that are much more stable in a time of crisis. So I think we're going to continue to invest into these business lines as well.
Where we've learned a hell of a lot about how we operate. I think probably this is a good thing in some ways, that we will become a much smarter, leaner business, because we were quite a top-heavy, fat business in some ways. And that efficiency will drive a better service proposition in many cases. Yes, I think so. I mean, one of the things that we've been working on is, I think that we live in a digital world now. And if you look at even banking, I know that UBS has invested heavily into their digitalization, and they have an excellent platform for clients. So you have access to your information anywhere in the world, on your smartphone, everywhere. What we're trying to do here is to provide our clients with the same thing. So apart from the personal service that they have from our brokers and our people, we're always available by phone, by email, you name it, to meet. But we're also trying to build a kind of online platform where they can access all the information relating to their dealings with us. So if you have a yacht owner, they can access their private area where they can see the live accounts, so the status of their accounts of the yacht. They can see sales inquiries if the yacht is for sales, charter inquiries, charter bookings, and so on. So really trying to
push that side and to provide a better service, a more digital service, a more modern approach.
Yeah, more modern. Thomas, let's go to the next session, please.
Yes. So the next session will bring us a message which is important, is in regards of this divergence that we already spoke about. And this is the last decade where was a divergence between asset price inflation and the real economy a little bit more struggling. So divergence in the economy is nothing new, is going to increase, is going to stay with us for the coming quarters, coming years. Nothing change here. We will continue to have to adapt to that. And when we adapt to that, it means we have to stay very flexible, active, and reacting, because what we see is the central bank intervention, for example. Back to our discussion on the lower expected revenue for this decade, you see here the very massive central bank interventions. That means in a way that the monetary market, so the liquidity in the market, is leaving the private bank sector and coming into the central bank's balance sheet. And the effect of that is that the manipulation and the distortion in the capital market will stay with us, with the central banks buying even at the long end of the interest curve. That means buying long-term government debts in order to bring the refinancing cost of different governments lower than it would be. So this is what economists will name the financial repression. So bringing some capital cost artificially low for countries that should pay more risk premia. And that will even accelerate when you see, so the central bank's net asset purchase on this chart, that were even bigger, much bigger than we experienced in 2008 and 2009. And also the more debt we will get into the system. We already talk about that. So you see on the left, for the developed market and the emerging market, what we can expect. And here, even much more debt in the developed market. They have also more money, so to afford to that. But still, so we'll here also have divergence, and even all the demographic issues is another problem that we accumulate. So this environment of financial repression is the one that's going to stay, is going, or even to accelerate. Nothing new, but the new debt level that we have created through this crisis, of course, is something that we add on the top of the debt level that we already have. The even more interesting graph on the right shows you that from country to country, the response is completely different. So we have on the horizontal axis, we have the debt to GDP, so to gross domestic product in a percent. And you see already here, countries' debt level is very divergent from a country to another. And then you have on the vertical axis, the deficit to GDP for 2020. And you see here, so the response country by country has been different. And so on overall, when you take all this information, what you can expect for the next years is difference in taxation. So now we are expanding the debt level. We are spending the money that we don't have today, and these countries are going to increase the tax or decrease the expense, which will be also needed, of course, over the coming years. But that will also tell you that some countries and rather that has been from a tax purposes already not very exciting and not very affordable and attractive, they will rather become even more expensive, so less attractive. And other countries, or even small countries, are trying to get better. What we can understand through destination competition for for your business, but also for for our business, for offshore business. So you will have in the coming years effectively countries that will manage all these issues, and adding to that the problem from the more depth of the lockdowns in a better way than other. And typically, our wealthy clients, they would have had a lot of real estate. Real estate, the problem is, of course, it's really for tax purposes the first target that some governments will use to increase their revenues. And so the results, maybe in the coming years, it will be very important to think about the existing location. Where am I situated and located? Will that be for the next years still the very attractive destination, yes or not? And it means that we will have to take in account the policy that will be implemented by those countries, existing luxus destination, but also we will be very aware about new luxus destination. And we know already Croatia and Montenegro for talking about the next to us. But in Asia also, Vietnam is making a lot of very good policies, and they are very reactive and very responsible in the way I think they have done their way to a better economy. So we will have to be in a way more global in our thinking in this environment where we began the decade and saying globalization is over and we are going to deglobalize. I think in some point of from some way you can think about this discussion is, yes, we may reshore, we may relocate some production, but thinking global is not over. And doing the business for luxury, but also for the banking business, is something that you will really be aware about the global opportunities. We say already being global and looking for new clients, something that we are going to do even much more aggressively than we have done to this environment, because again, on display and competition between winners and losers that will intensify. Yeah.
Is it fair to speculate we've not seen the smart money moving yet? The pandemic, recession, economic and political impact won't hit until the third quarter. Is that a fair comment?
Well, it's a question of how can we measure and observe the move of the smart money. So we have, of course, in the short term, we have, of course, typical the smart money going to invest in the well-known stories, and that's exactly what happened in the last month. But when you think about the next years, I would rather think there will be the smart money trying and understanding all our conversation, because everything what we are talking about is something that the world of investors is going to realize or already has understood. And so the trends are too strong to be stopped here. And I really think the smart money is going to go to a new destination. That's something that already happened with new developing countries. That Vietnam again, I take this example because I know this country. I worked closely with Vietnam, and I know how attractive the business is there. So you will have those new destinations, and the smart money is going to those destinations. Montenegro is one. I certainly, perhaps, Jenny, or you have some experience with those new destinations around Europe. But this shows you clearly that the people, they will compete, and the smart money is going where there is more competition, where there is the good offering. And I'm very confident that in this world we will have new good offering at very attractive condition, and the smart money is going to go there. And at first the smart money is going to go to those new destinations, and we will realize that already when the smart money has already been moved to those destinations, because it's nobody is telling you, I take my money to this destination. They just do it, and then you have to come back and say, oh, I see they have built new hotels. I've seen they have a new facilities, and something is happening here, and it's already implemented.
Yeah, I think that's the point. They're already smart by definition, and therefore they're first movers.
Yes.
And they're the ones that drive this dynamic motion into the investment community.
Yeah.
Let me bring Jenny back into the conversation. Jenny, I'm interested to know what you think in terms of your own investment strategy as Camper Nicholsons. How has this changed your let's say investment strategy with your parent company, with your overall business plan for the future?
So we run a 3-year strategic plan and budget that we renew every year, and we have a very clear investment strategy. To be honest, I don't think this crisis has changed it at all. It's just convinced that we're on the right track. Basically, we have 2 approaches. So first of all, we invest a lot into organic growth through improving our core business. This is what we've done, all the normal, the basic services that we've provided within the yachting space. We try to optimize this. We try to do some cost optimization to expand our fleet. So we have expanded massively in the last year or so, the size and the quality of our fleet of managed yachts and yachts under charter. We've also added expertise in a new build to reinforce the capacity and capabilities of our sales team. So really focusing on building up the core business from within. Then the second approach we have is inorganic growth. And in this space, we're looking to expand and leverage off our brand, expand into complementary industries. We did a joint venture, which has been very successful with the Skoog Group in the insurance space a couple of years ago. And now we're looking at doing the same potentially in the real estate business and real estate rentals. So those are the 2 investment approaches we have, or growth pipelines that we have. In terms of the core business, what we're doing now, apart from expanding in the areas where we are, which is Asia, Europe, and the US, we're also looking now to expand geographically. So really to have that outreach, as Thomas said, to reach more clients, to be present in more geographical areas.
I'm very interested to know what you think of the yachting space from UBS's perspective, just as a separate sort of topic here, because what we're seeing is a lot of individuals investing in yachting companies. We're seeing high net worth clients seeing yachting as a passion play, let's say. What is UBS thinking about yachting?
Yeah, so I will also give you an answer top down and based on our analysis that we go through together. Certainly is that yachting is more mobility type of investment and leisure type of investment. First of all, there is no reason to think that leisure will not have a bright future. So we have so many people that try to maintain the fees level at the highest possible in order to get their audience, and they say, oh, the new normality will be leisure, will be very depressed, and I don't think so. We already have evidence that we have a pent-up demand for leisure. So this is really a thing that even a few weeks ago we were very critical about. Is there any pent-up demand? And now you see really the news coming and saying, yes, there is a pent-up demand. The people want to go and have good time and expense right portion of the budget for leisure is not going to change. So I'm very optimistic for that. And then on the other side is the question of tax. So we will be very aware, and I think on your side, one element will be certainly to have close contact to tax specialists that will tell you, okay, this location is engendered, or there is this kind of reform that politicians are talking about, so pay attention. The other destination, it will be more attractive. So I think mobility will rather be a good point in those kind of investment, in contrary to real estate. We know all, typically we had this good investment in luxury destination. We spoke together about South France. I take again this example based on the experience the French people have made with their politicians during this lockdown. This was really, really extreme, was what they have done themselves. So and on the top of that, they will accumulate deficit and debt level that are very, very, very politically problematic. So here, having your luxury property in South France is something you are going to think twice, or there will be some reforms. And so the question will be, I think, nothing against your business and your industry, rather good, I would say, good signs that it will stay very attractive to people looking for mobility and looking for safe place. And when you are in your area, you can change your destination quite quickly. That's the goal of having your boat. So I think was a good future, and yeah, no issue that we should be pessimistic about this industry at all.
Okay, good. One question just came in there from Rory, who's watching. This topic of conspicuous consumption. I know it's been a big topic across the World Economic Forum in terms of wealth inequality. How do you think that's going to impact the next decade?
It's difficult to say, because again, we do not forget that we have competition between different destinations. So we will have, again, some countries that will really struggle. And we know which one. They are the ones that already have a lot of debt, accumulating even more deficit, and then they will have to raise taxes. There is no issue about that. And so some destination, other that are not in those inherited problems, they will look at those countries and say, okay, those countries are now applying the bad policy, so it's a good timing for me to be very aggressive and to attract these potential wealthy clients to my destination, to my place, and the play of the competition will be even more aggressive. So the question is, I think, is whether is not on overall what's going to happen. We are going to pay more tax and so on, but whether to stay very aware about how the politics and the policies are evolving in the different destinations, the one we know very well and the new that are being created, and then to stay very aware about, okay, we can speak for some about London. The politic about that has been applied by London is very interesting, but I think those experience that we are going to do them again, and some destination will lose attractiveness and other will gain other. But on overall, I'm rather optimistic about the fact that there is enough destination of high quality that will understand that they need to attract those wealthy people. They are the people that pay the taxes in any way, the high or the low tax. The wealthy people pay the tax, and so at some point of time we will get some country that will understand these realities, and they will have to apply new policy solutions in order not to destroy the wealth basis. So from that point of view, I think the play of the competition let me to stay rather optimistic or not too pessimistic in regards of those discussions. Yeah.
I think it's an interesting subject, because what I think is sometimes misunderstood, and Jenny, maybe you can comment on this as well, is that actually the world's wealthy population, the ultra high net worth population, pay the largest amount of tax of all people on the tax system, and that's sometimes misinterpreted or misunderstood, and we do see a lot of let's say political or media attacks on our marketplace. Jenny, what do you think about this topic of inequality and the wealth element here?
Oh yes, well, I mean, it is a very sensitive topic, and of course, our clients are in the spotlight. On the other hand, as you say, they often pay, well, I would say most pay a lot of tax. There are also a lot of entrepreneurs. They drive big businesses. They employ a lot of people. So I think I take quite a relaxed approach against it. I think that they also bring a lot to this world. There's a lot of philanthropy. But then, of course, media will blow everything into the way out of proportion or into what they want to show. That's the media. I do think that our clients do contribute a lot with business, with taxes, with philanthropy, using their context to influence to also improve the world. So, yeah, and then, of course, then the Superyacht market might have to do more to promote itself and to promote its engagement into ocean protection. For example, we have partnered with Mission Blue to promote their network of marine protected areas across the globe and the hope spots. So I think in our market, maybe that each company needs to really show environmental and social engagement at their level. But this is something that goes for every industry, really, because coming from the mining industry has a terrible reputation. And all the same, when you're somebody to work on the ground, if you work for one of the big leaders, you do so much. And these companies have implemented enormous and very successful projects on the ground in many third world countries that have helped the local communities. So I really think that, you know, it's up to each one of us to take a look at what we do, how we live, and you know, we can say attack the rich, but in the end, I think at every level, everybody has to take a look at what they do themselves.
Yeah, I think it's a matter of education though as well, isn't it?
Mm.
We have to educate in terms of what people are doing, as you say, about the environmental sustainability contribution yachting can make or is making. The same with Thomas's business in terms of the impact of investment that has a eco or a sustainability sort of pillar needs much more transparency or clarity to show the good things people are doing. I think that's part of the future we're looking at in terms of people who are investing at a very high level need to explain the value of that investment, not just on a monetary level. That seems to be what's happening in the banking world and the yachting world, almost in parallel. Is that right?
Absolutely. So it's a very good point, I would say, because that's what I wanted to show you through this presentation. Also, the facts are speaking by themselves. So when we read the newspaper, we hear the discussion in the public and what the proposition comes to the politicians. The best things you can do is do your job the best way you can understand it, and incorporating also those elements we spoke about, and ESG and all those things. And then when you are really confronted, you know, it's more than just having headlines in newspaper. When you're really confronted with the reality, and your entrepreneur, our companies are in a face-to-face discussion with politicians, and politicians, yes, you should do this, you should do that, and you come and say, look, I've already done it. I've already done it. I'm member of this association. I engage in this kind of measure of programs and so on. So it's on the table. It's already done. And I mean, this is the best way to make a difficult conversation to a very efficient and short one, and say the facts are speaking by themselves. We are the one, and your clients are the one that are paying most of the taxes. And on the top of that, we try to do our best to improve anything we can improve. And when you have to face-to-face conversation, bring the facts on the tables, and then the politicians, they will act based on this conversation and not on what in the newspaper. And as typically, you know, perhaps better Italy than, but Italy is always so a lot of noise. But for some, I know, also personally, some people, when you go to Italy and you're a wealthy person, then you may have a very well situation, even a better one than in Switzerland. So depending on how you invest, how you position, and how you optimize your tax, and how you deal with the public, with your environment, you can do it very nicely. So always keeping in mind, and there is this noise, and there is the reality, and if we act very responsively, then we have done the job, and let the facts speak by themselves, and stay rather optimistic, but not forgetting that, of course, things should be monitored, and more than ever.
Yeah, sure. Jenny, let me ask you one final question, I think, before we come to an end of the webinar. This topic of eco and sustainability is very important in terms of perception of yachting, but we're an industry that seems to have a limited growth cycle. From a UBS perspective, there are hundreds of thousands of individuals who could afford to be in the yachting space, yet they choose not to. So from your point of view, Jenny, what do you think we need to do to grow or develop or bring that customer base into our world? Because I'll ask Thomas the same question directly, but I'm interested if you have a view on this as Camper Nicholsons, or as yourself as a person from the investment world in the past.
As you said, it is a niche market, and not everybody are into the sea and the ocean and being on the water. So I think that is just a fact. You have people that prefer to be on land. Then I think that the industry can promote maybe more the link to how you can, those that are passionate about the ocean or don't know it, I mean, we can definitely promote ourselves better. We can also, maybe there is this perception, I would say, that super yachts are only lying outside Saint-Tropez in the summer, but they can also traverse the world. You can go and see some of the most remote locations in the world, the most pristine locations of wildlife and so on. You can even set up expeditions together with researchers. There's a huge potential to get involved in ocean protection, in promoting the, I would say, the ocean protection, and to build awareness about what's going on with our oceans. So I guess that is something that we can do to try to build a better picture of what the boating industry is about. And but then, of course, it remains a luxury segment. Then I would say another thing that I think that we need to work on in the industry, and feedback I've heard from some clients, is that some have had bad experience with the lack of transparency. I think this will be resolved through the new this new decade, where you see there's a lot more regulations. We also have a lot more financial, even listed investors behind the companies, which means that the companies need to work in a much more transparent and structured manner. So I think there's definitely opportunity to also improve the reputation there towards some clients. So it's a difficult one, to be honest, but yeah, I'd say that's what I see.
This is the real subject here. What makes yachting investable? Because we need to bring more people in with, let's say, more of a strategy to help grow the industry and to professionalize and give it more stability, let's say. So what makes it investable?
I would say one of the things that I saw when I got into the industry, my boss at the time came into the office one day and said, "Jenny, I bought a new company." And I had no idea what this was. And when I saw what he had bought, my first reaction was, this is just a couple of years after the global financial crisis. So the market slowed down, and it was quite difficult with most of our investments in his portfolio. Now, first reaction is, oh my God, what are we going to do with this? He bought something in the luxury market, and I mean, the markets are down, and this must be a catastrophe. But because it's a niche, and because our clients are extremely wealthy, and as we said, there's always winners and losers, even in the crisis. We're going to have some new clients now that have made a lot of money during this crisis. So it's a small market, it's a niche market, but it is quite stable. It has never suffered as other markets has during any crisis, as you've seen right now as well, that yes, we're suffering, but I think the recovery will be much quicker than any other, or a lot of other industries. Then I think the other opportunity is that it's been managed and run in a very old school and traditional way, if I may say so. And by modernizing, by analyzing, by bringing people in that has maybe more of a business perspective on it, looking at the margins, looking at new opportunities to expand, to diversify the service offering and so on, then you can really, well, you can build a nice story, I would say, from an investment perspective. So there's a lot of opportunity, a lot of potential, but yeah, you need to do it in a more analytical way, I think, more structured way than it's been done before.
Yeah, and Thomas, as a final comment to the webinar, what advice would you give to people in this current situation?
Yes, perhaps first adding to that, to make your industry also more investable is having a very transparent and effective secondary market. So when you buy a new, and you have, like in the real estate market, you have the experience of being able then to sell it again on the secondary market or to buy on the secondary market. So something also here, perhaps we can improve the transparency and the way you access all those products in the market on a global scale in order to be very liquid in a sense of investment. And otherwise, to summarize a little bit, we have seen we entered this decade with some trends. I think what happened has accelerated rather the trends and not creating new trends. We should not be afraid about those new normality and whatever. The normality is something we define, not the politicians. So we decide on our way of life, and we keep to that, and there is no reason that we are going to do it and the people are not going to do it. So in a sense, I stay from that side rather positive, and also because the experience we have made with those policies are very to stay neutral, are very mixed. So this is nothing I think that is going to happen again. Like the fears are around, we are going again in another round of lockdowns. So I don't think so, because the lockdown experience was not a good one. So it's over. It's not going to happen again. That will be my base case. So look forward, implement what you think is good, come with the facts on the table, and the facts are the element that will bring everybody, every entrepreneur to the success, because you can discuss around the things, but when we bring the numbers and the facts, you end up any discussions and you make great progress.
Sure. I think Carmen's final comment there is quite avid, quite relevant in terms of the yachting is an Onassis philosophy whereby you're buying a yacht to be part of a unique club. And I think that's something that we all need to recognize, that actually, if you want to be in this club, it's accessible if you know how to and which way to go. So let me ask Jenny for your final closing quote on what you think is the future of our, which is relevant to exactly what Thomas was saying. It's like your Charles Darwin quote is so appropriate to the investment strategy. So over to you, Jenny, finally.
Okay, so my final word on this is one of my favorite quotes, and it is that it is not the strongest of the species that survives, but the one that is the most responsive to change, I would say.
Which I think echoes exactly what Thomas is saying, is that the smart investor is one that has the flexibility to move very quickly, very smartly, and change their direction according to almost the sort of instinct, I would say, in some cases.
Yes, okay. Absolutely. I think so, because investment is about opportunity, instinct, luck, and analytics, I would say.
And analytics, yes, exactly. Otherwise, Thomas will be out of a job.
Yes.
So listen, thank you very much, panel. Thank you very much, audience. I hope you enjoyed that and find it very valuable. I think the one thing I'd like to say is it's a positive conversation, not a negative. The future is not all negative, as our politicians or media may say. So thank you, everyone. Goodbye.
All right.
Thank you.